Hi, everyone. Good morning. We are embarking on the famous 1031 day tomorrow. So it's perfect timing that everyone's joining on 1030. My company, all my sales reps and employees and our teammates that I just geek out over 1031 day, but it's like, come on, this is what we do. We have to play to our strengths, right? For those of you who I haven't met in person, I know a lot of you re-attend my class a lot, so I'm bummed this one isn't in person, but we'll figure out next year. I think there will be a couple in person, so I'd love to meet you all in person. Again, if we haven't met, my name is Kayla Farking. I am the Vice President with Leader 1031. I manage the Western United States, and we are a national qualified intermediary. So I have been doing 1031s for almost a decade. I am licensed in California. I have been, gosh, since 2011, I think I want to say, just renewed again. So it's always good to keep education going. Again, thank you so much for being here today. It really truly just shows a testament to you, and education is, your growth. Everything you do, you got to keep learning, got to keep growing. How can we get into the market right now? Coming up on election time, it's always good to kind of, keep everything, the wheels of momentum. So today, I'm going to talk about frequent 1031 exchange mistakes and pitfalls to avoid. So there's 9 overall topics, and before I get into it, I want to just do a quick crash course on about 5 minutes of what a 1031 is. For those of you who typically attend my class in person, a handful of you have no idea what a 1031 is. So it's good to have a quick refresher. And as you see, Elsie is writing in the chat. Please, if you do have questions as I'm going through the presentation, type them in. I want this to feel like a safe space. There's no stupid questions. That's why we're here to learn. So I'm happy to share my knowledge that I can with you. Again, I work for a national qualified intermediary, and I am not a licensed security professional. I am not a licensed CPA, and I cannot give legal tax advice. Moving forward, here's what I just said. Disclaimer, none of that. Don't ask me legal tax advice questions, please. Now, I like to start out with a knowledge check. So please be ready on your keyboards, or if you're on your cell phone, listening in. I know we're busy out there. Keep them rolling. Does anyone know what IRC stands for? So IRC, and I'll give it a second here. No responses, no takers. All right, we'll get warmed up here. IRC actually it's an acronym. We love our acronyms in real estate, but it stands for Internal Revenue Code. So IRC, Internal Revenue Code, Section 1031. So we're a section of the tax code. The fact that it landed on Halloween was just a win for me. I'm not the biggest fan of Halloween. I love Christmas. I like, as soon as Halloween's done, it's like Friday morning, we're gonna have lights up. So, but IRC, remember, Internal Revenue Code, Section 1031. All right. Now, does anyone know when IRC Section 1031 was added as a tax code? So how long has it been around? Wait here. No takers, no takers. Okay, so it's actually been around since 1921. So a lot of dialogue that we're hearing in real estate, a lot of changes that we've seen in real estate. I know Elsie's putting guidelines and different settlement things in the chat. So in conjunction with real estate and changes that we're seeing from NARCA are all of these items that are being revisited in topics. So is 1031. This isn't the first time 1031 has been on the chopping block by any presidential candidate or current president that's sitting. They've been around since 21. We still have them. I expect that they will still be remaining, no matter what happens in this election. Now, does anyone know when the exchange period ends? So there's always these timelines in our exchange, and a lot of us retain these timelines and figures. I'm gonna go up to my chat. Nothing up there. Okay. So actually the exchange period ends in 180 days. That's the entire exchange period from the close of escrow on the relinquished property and you have this additional 180 days to effectively close on a replacement property. There are various rules and regulations on the front portion of that timeline, which we'll get into in a moment here. But please remember, from start to finish, a 1031 exchange must be completed in total, the sale of one relinquished or one or more replacements in 180 calendar days. Now, does anyone know what the maximum amount of capital gains taxes you can defer is? Okay. No takers yet. Come on, guys. I believe in you. There is no maximum amount. So this is my trick question. And I bring this up again because part of the highlights on this class was updates on tax plans and what current events are. So there is a proposal, again, to cap capital gains taxes. And what that means is, let's say you buy a property for $100, okay? And it appreciates to 200 when you sell it. You bought for 100, that's your basis. You sell it for 200. So that means you have a gain. It went up in value by an additional $100, right? So right now we can defer the entire amount. So we can sell for $200 and buy something for $200. There's no cap on that, right? We're not seeing anything changing. We're not going to worry about what's to come. All is well. We're free to roam about the cabin. So when I have an exchanger that has selling a commercial property for $20 million and they want to buy maybe 20 investment properties that are residences, single family detached, they can exchange any amount in capital gains and defer it down the road, keep kicking, kick the can down the road, defer the capital gains taxes. Now that we got through the questions, what is a 1031 exchange, right? What is this? We know it's an internal revenue code. It's a section of the tax code created in 1921, but what does it mean? So directly from the tax code, this is my quote that you'll see on your screens for those of you that are following the screen on. No gain or loss shall be recognized. So you're not paying taxes on the exchange of real property, specifically real estate, held for productive use in a trade or business or for investment. So that means no primary residences, strictly investment property, right? If such property is exchanged solely for property of like kind, what is that? We'll dive into a few pictures here of what's exchangeable for one another, but like kind must be real estate held for investment. So you have to also hold that replacement property for productive use in a trade, business, or for investment purposes. Now, I obviously remember this. This is to my core, right? I recite this daily if I need to. About a decade ago when I learned about 1031s with my broker hat on, it was just ingrained in my soul. So a simple way of retention, this is what I typically tell my clients. It's a sale of one investment property followed by the purchase of another investment property, facilitated by the qualified intermediary or 1031 exchange company in the middle. So I'm in the middle, right? Now, when we look at this, I use the word facilitate and qualified intermediary. Some terms here. Sometimes a qualified intermediary is referred to as a QI, right? Magnum QI, or we're QI. We're referred to as a facilitator, an accommodator, right? So we hold the funds in between the sale of one investment property and the purchase of another investment property under safe harbor regulations and restrictions of tax code, internal revenue code, section 1031, right? So we are that key component in what defines the difference of a traditional sale and a 1031 exchange. Now, again, I can't help but reiterate the delay. You're delaying a taxable event. If I keep exchanging my $100 property that went up to $200, and maybe that $200 property grows into $1,000 down the line, I can exchange that $1,000 property and buy 2 replacement properties at $500. I can keep exchanging that until maybe my net worth grows up to millions and millions of dollars. The only time that person, or me in that example, would be paying taxes is when I liquidate or when I sell an investment and I have actual receipt of funds. So I'm touching the money. So we have this morbid term in our industry. It's called you swap till you drop. You exchange until you die. You never pay the taxes. So you're delaying the recognition of capital gains taxes on your investment real estate. Okay. The goal of that swap till you drop is also a bonus where when you pass away, your beneficiaries get a step up in basis. This is still applying. It was not eliminated. So you get a step up. What that means is, let's say my property that started at $100, when I sold it and it was valued at 10 million throughout the duration of my ownership and exchanges and growth, my children will inherit the property at 10 million and they can sell it for 10 million without paying my capital gains taxes all the way back to the $100. That would be a large capital gains tax event, huh? So it's a win. Life estate planning. So the traditional sale, you sell real estate, you collect cash, right? This creates a taxable event. In a 1031 exchange, you sell real estate and collect more real estate, thereby eliminating a taxable event and deferring those capital gains, right? Kicking the can down the road. So in my humble opinion, this is the last and greatest tool or tax code available to real estate investors, right? This helps someone who maybe owned farmland in Bakersfield and bought it for 20 grand and it appreciated to 100. That's still a lot of gain. They can exchange that, maybe use that all as cash as a down payment and buy an investment condo that later can convert into a primary residence. So it also would benefit maybe someone who's selling a hotel. I just did an Irvine hotel exchange. Someone who bought it for 3 million about 3 decades ago, improved it time and time again, decade after decade, right? And then eventually exchanged it for about $12 million. Smaller hotel, but doing that exchange, they now bought 3 single-family residence properties for their 3 kids to later on inherit, right? And they're rental properties. So either which way we're going, we're taking this avenue of 1031 to redeploy investment into more real estate held for investment. I'm gonna pause if anyone has questions so far while I take a sip of water here. Okay. So who are we targeting, right? Who are we looking for what are the reasons to exchange, right? These people are maxed out on depreciation, right? 27.5-year line for residential real estate. Maybe they've done an accelerated depreciation. Maybe they've used it all for their entire amount on what they purchased and used for their tax advantage to shelter income. Maybe they have co-owner problems, right? I'm working on a transaction right now with someone who owns an investment property with their ex-spouse, right? So they're changing title. They're going to be 50-50 tenants in common, wait a year and a day, and then do a 1031 exchange and go their separate ways. Tired of being a landlord, right? I don't want to manage this rental property. I have 6 of them. Can you list it for me? Can you list all 6? Heck yeah, let's do it. Well, what's the plan? Maybe they take all 6 and consolidate them and buy one larger asset. Maybe they buy alternative investments. Maybe they want to relocate, right? That was a huge one during COVID. It still is. People are moving to different states. So maybe they want to move their assets with them. They want to leverage tax deferral benefits, right? So exchange, like I said, you can consolidate, you can obviously diversify, buy multiple, using that capital as down payments to leverage and maybe get a loan to fulfill higher purchases, growing their portfolio, which thereby improves their cash flow and gives them more of that portfolio down the line. Before I get into Pitfall 1, we do have a question from Karen. Hi, Karen. She said, how can you take a primary residence and get it into the loop for a 1031? Keep it as a rental? As you get closer to dropping, can you keep a down lake property as a primary residence after it was a rental? So number 1, if you want to convert, kind of a funny word, but if you want to claim an investment property as a primary property as an investment property, you can, right? So let's say you move out of it today. Now it turns into an investment property. Once you hold that investment property after you've owned it for a total of 5 years, right? Living in it for a minimum of 2 of the last 5, or a portion of the last 5, right? 2, then you can exchange it. So you get a fraction of benefits on both. I would consult with the CPA, the valuation and what that would look like for tax deferral. Keeping as rental, get closer to dropping. Can you keep a down lake property as a primary residence after it was a rental? Yes. So on the flip side of that, let's say you did a 1031 exchange from one investment into another investment. Once you hold the replacement property for an investment, let's say it's a VRBO, right, vacation rental, for at least 2 full calendar years, you can then move into that property and claim it as a residence. So again, that timeline is 2 full calendar years. And then Christina, hi Christina, she asked, will the children pay capital gains when they die and the children got the property? So in my example, the swap till you drop, right? When you do the 1031 exchange, and let's say I don't have children, but let's say I have a daughter and I die and she inherits my property. If that were the case and the property's current fair market value when I die is $1 million and she wants to sell the property for $1 million, she can, and she does not pay a dime in capital gains taxes because she received a step up in basis. That step up in basis in my example is that $1 million. She stepped up to the current fair market value or the new basis of the property. So kind of a neat life estate planning strategy rather than taking a hit, paying capital gains taxes. Now, pitfall number 1. So this is a big one. I can't stress it enough. We have to set up a 1031 exchange prior to close of escrow. Okay, you cannot close and record on a Friday and call me on Monday. It's a done deal. We cannot backdate documents. We do not do that. That is illegal. Okay, so when we're setting up a 1031 exchange, even if you have a client that's closing, let's say tomorrow on 1031, end of month, of course, right? We all get that. And they say, wait, I actually decided I want to do an exchange. This is an investment property and I may want to see what's out there. Stop the closing, stop recording from happening tomorrow. Call me, we can set up an exchange in an hour, we can consult with the client, and we need to communicate with escrow and title. Okay, we have documents that are put into place to secure that the client is doing a 1031 exchange with literature indicating they're deferring taxes by the use of a qualified intermediary or 1031 exchange accommodator. Right, so we need to initiate that 1031 exchange prior to close of escrow. I can't stress enough to you how much this pains me. People who aren't educated and then close and then decide, hey, wait, we want to do an exchange, but I sold my apartment, or excuse me, my condo about 2 months ago. Right? It's so depressing for me because that person who had so much sweat equity in that property could have benefited by listing their property with you, doing a 1031 and redeploying that entire investment into something larger as you represent them now as a buyer's agent, right? So it's such a missed opportunity and there's so much capital left there for what we would otherwise be paying in capital gains taxes. Constructive receipt. Here's an example. Oh, wait, well, I closed escrow on Friday. I get this call on Monday. I closed escrow on Friday, but I didn't touch the money. It's sitting in escrow. Still technically a taxable event. We call this constructive receipt of funds. That wire is set to go out to the client or a check, cashier's check is cut to them. You've already got your commission check. It's recorded. The burdens and benefits of ownership of that real property ownership life has transferred to the buyer, right? Those are my B's. The burdens and benefits have transferred to the buyer. It's a done deal, right? And of course, actual receipt of funds, receiving the money, right? Oh, the wire came to me, but it was only in there for an hour. It still is a taxable event. We cannot wire it back. We need to have a contract binding in nature between a qualified intermediary that includes what's known as an assignment. That needs to be signed by our seller, our exchanger. So David asked a question here. Is there a cap on how much a property can step up? No, there is not currently. It has been discussed. The last 4 years, nothing has happened. We haven't seen anything happen, but that there are talks of that. But currently, I'm having a lot of volume of people wanting to exchange prior to the end of the year, prior to certain events happening. So the goal is to kind of keep using it while we can, but there's nothing that's set in stone. And then Brooke asked, wouldn't they be able to do a reverse Wouldn't they be able to do a reverse exchange? I don't know what the question is targeting, but we can do reverse exchanges, and I'll dive into that at the end here on if you've exhausted the delayed exchange, there is an opportunity to capitalize on purchasing the replacement property first at a higher cost because there's an association with an attorney and entity movements. So thank you for your questions. I appreciate it. Now, I'm sure you've seen this most likely in the MLS. Sometimes, you have your SXA, right? Seller's Exchange Agreement, right? That's a lot of the time that you have in zip forms and it'll pop up. It's your seller's intent to exchange form. This is also a cooperation clause that you can put into your contract as, extra carryover notes and addendum, you name it. This should be in there. It's not necessary, but it's beneficial for you as a listing agent to be very clear when a document comes in and you've opened escrow with a buyer and they have no idea what a 1031 exchange is and it wasn't disclosed. Even though there's no cost to the buyer, it still creates a little fear for some people. I've had about 4 transactions in my decade of doing this fall out. Obviously not very many in the thousands and thousands I've done, but it does happen. So when an assignment comes to the table in this escrow package, or it comes from escrow or title, and the buyer has to sign it, like, what the heck is this? Why am I doing this? It's good to just be upfront, right? The seller's doing a 1031 exchange at no cost to the buyer. And same on the flip side, cooperation clause on the replacement when writing offers, right? Just let the seller know that they're aware that the buyer intends to perform an IRC section 1031 tax deferred exchange, right? A lot of the times on the buyer side, this is a win because as a seller and a buyer comes in as an exchange buyer, they're up against a lot of timeline restrictions and they're very desirable. They know that they effectively need to close to defer capital gains. So it's always good as a listing agent when you get an exchange buyer coming in. Speaking of the timelines, just a quick revisit and refresher. When we're doing a 1031 exchange, we pull off your contracts. Your RPA will indicate the close of escrow timeline. When we approach that timeline, we start with our exchanger, who's also your seller. Close of escrow occurs, and the sale proceeds are wired into a segregated account that we hold at Leader 1031, backed by Leader Bank. We hold those sale proceeds in certain restrictions and regulations of the tax code. You find them replacement property. We wire those funds over once received a contract, secure wiring instructions, disbursements, a lot of red tape, I'm sure you can imagine. And boom, we've completed a 1031 exchange where title is now recorded in the name of the exchanger. Now, the certain regulations and restrictions is the tough part, right? It's easy to list a property and sell it. But what about the replacement? Talk about supply and demand in our area in SoCal. Timeline requirements, day of close is day 0. The following day begins a timeline of 45 calendar days. 45 calendar days is a month and a half to find replacement property. That exchanger has to find that replacement property and formally identify that replacement property to their qualified intermediary, me. After day 45, they have an additional 135 calendar days to close on only the property they ID'd if they need it. So let's dig deeper here, right? When we look at identification requirements and what is an ID, right? The property identification must be delivered to the qualified intermediary and must be in writing. So we have a form that goes out upon receipt of funds package. We have to the penny what we're holding, their timeline, and our ID form. The client must unambiguously describe that property. It's an address, 123 Main Street, right? And sign off on it, okay? The client can, or exchanger can, revoke that identification if it's before day 45. Say they write down a property and they do an inspection and they hate that property. They don't want to repair it. They can revoke that ID or revise it, put a different property on there. So if they were to revoke it, and now we've reached day 45 and it's day 46. If that occurs, then the sale proceeds we're holding are wired back to that exchanger on day 46, and boom, taxable event, they're an actual receipt of funds. The other side of the coin occurred where the exchanger taxpayer ID'd a property, and let's say it's now day 70, okay? And they decide, this isn't the property for me. A con here is that they did ID, so their intent was to purchase that property. If it falls out in that additional 135 calendar days on day 70 in my example, the cash we're holding must stay in that segregated account in accordance to the IRS, who forces our hand as an accommodator or qualified intermediary until the end of the exchange period. Early on, we talked about that timeline. Day 181, that's the day after day 180 or the end of the exchange period. So my advice is be very confident in what the client's ID, and identification is not an offer. Your clients could make 10,000 offers. What I'm looking for is something in writing indicating this is their final selection. Okay, so they could go in and out of offers within the 45 days. They could even be in escrow with the relinquished and the replacement at the same time. All right, all of these are completely acceptable within the tax code provision. We do a lot of simultaneous exchanges, and some even close within 2 weeks of each other, right? So you're within the 45-day window, but you didn't need the whole timeline. It's available if you do need it. A quick pause here. It looks like we have Q&A here. Okay, Terry. Hi, Terry. Regarding step-up basis for beneficiaries, only children? No. So spouses get half step-up basis. Okay, so half of that capital gains taxation will go away, which is a win. And then Rosalina, hello. To exchange for equal or higher properties, that means the seller has a higher mortgage payment than before, even though it was capital gain deferred. So what is the benefit truly? Good questions, right? So when we talk about capital gains, if my $100 example, if it went up to 200 and I didn't exchange and I bought a $300 property, well, where did I get that extra 100? To Rosalina's point, I could have got a loan for the extra 100. So now I'm leveraged at about 33%, right? I own $200 cash that I exchanged, and then another 100 is a mortgage. So my benefit there, when I talked about max out on depreciation, maybe I depreciated that entire property, and that's CPA questions for depreciation, but one of the wins of owning investment property is depreciation. You're sheltering your income. So they would exchange for a higher amount. Now they have an additional $100 to depreciate. Okay, so that depreciation does follow you from the first property from your original basis, but that could be a reason why a lot of people want to grow their portfolio. Maybe the $100 property that I owned, when I grew my wealth and it went into a $300 property, I can actually get more rental income. Maybe it's in a highly desirable area, right? Maybe I take my $200 sale and I buy two $200 properties. So now I'm at 400 and I used each cash component as a down payment, right? So there's a lot of ways as far as strategy and what investors desire to do, right? So going up in value isn't necessarily a loss for a lot of investors. It's a win because they're getting a higher return on their asset. Hope that answered both. So I said, okay, we go. All right. All right, one more question here. Anna, hi. When does the 45 days start? Close of escrow of the first property. So close of escrow, let's say, is today. Day 1 would start tomorrow. If you record today, that's day 0, right? Tomorrow's day 1. And then Tony, hello. Co-owner problems. I thought it has to be the same as the sold property vesting. How would new vesting be if co-owners want to go separate ways? So when we pull title, right, we can see tenants in common. Tenancy in common with who? So let's say Kayla Firking was tenants in common with Tony Choi. Okay, and we're both 50-50 owners of tenants in common of $1 million property. I own 500, you own 500. When we sell that property, I can buy a property in Chicago if I want. You can buy one in Florida. You're doing your own technical exchange of the undivided interest that you have in your portion of real estate that you've paid taxes on to defer your gain. So I hope that helped answer the question. I have another pitfall as well that follows suit with entities and co-owner problems. So we'll dive into that. But I really appreciate the question. Depending on, so the question is that will work with joint tenants. It depends on the taxpayer, right? So typically, yes, if we're defined as 50-50. So my follow-up question to someone who would say, well, I'm joint tenants with so-and-so. Okay, are you paying 50% of the taxes and they're paying 50%? Yes, I've declared that we do 50-50, right? So it really comes down to what the client is telling us. We're not giving them tax advice, but they're telling me they're paying taxes. And when I pull title, it sometimes will indicate 10% owner, tenants in common with a 90% owner, or 4 different owners at 25% tenancy in common, right? So we have to ask those questions, and I'm pretty good at asking those questions to understand who's actually paying the taxes and getting the benefit of the tax deferred exchange. Always work with your title reps to look at those deeds and title work so that you're ahead of the game, right? Even before you draft an offer or a listing agreement, it's good to know who the actual taxpayer is on title. Thank you for your questions. So pitfall number 2, we're going to roll in here to not understanding the requirements for full tax deferral. And what is a partial exchange? So the common misconception is it's all or nothing. I bought a property for 500K, I'm selling it for $1 million. I have to buy something for at least $1 million. That's not the case. So I have an exchange equation on the next slide, but something here I really want to hit home on is that your clients can do a partial 1031 exchange. What that means in my example is bought for 500, sold for $1 million, right? Maybe I find something for 800K. Well, I went down in value. That's okay. I did a partial exchange. The ramifications there are on the difference of my 200K, I'm paying taxes, but only on the 200K. A lot of our clients are preferring this strategy right now to have some liquidity, some capital on hand, take a little hit on an amount, and then keep rolling it into more real estate to get a higher return. So this is definitely that misconception of clients, well, I don't want to do a 1031 because I don't want to buy something for the same or greater. I think that coincides with Rosalina's statement, right? Well, you don't necessarily have to go high. You can go maybe use a portion of it and do a partial exchange. So it's a win-win and you've landed the listing. Your client defers a portion of capital gains and you find them a beautiful replacement investment property. So what does that look like? And I want to talk about boot here as well. So let's give an example. Your listing is a $900,000 property, and this client has a mortgage of $300,000. Okay. The net equity is going to be $540 because the closing costs or commissions, right? Title, transfer, recording, escrow is around 60 grand. Okay. So that means after everyone's paid off on your settlement statement, $540 remains. So that $540,000 would be wired into a segregated account held by their qualified intermediary. Now the rules for full tax deferral, again, this is not a partial, this is full tax deferral. This person doesn't want to pay a dime in capital gains taxes and they want to redeploy their entire investment. So what that means is they have to do 2 things. 1, reinvest the net exchange proceeds. That's this 540 number, right? So they have to reinvest that amount. And number 2, they have to acquire a property with the same or greater debt. Okay, well, my debt was 300, right? So you find them a replacement property of $1.2 million. This one's easy, right? They went up in value from the 900, regardless of closing costs. They bought something for 1.2. Hey, Mr. Lender, I'm going to take out a loan in the amount of $660,000, and Leader 1031, my QI, is going to wire over the 540K. We get notice from you that they've signed a fully executed residential purchase agreement. We communicate with escrow, get wire instructions, have our client sign and disperse. Out the 540 goes, the lender brings in the 660, close of escrow occurs. And this client is very, very happy because now they have a higher return potentially maybe on rental income in a $1.2 million property. They utilize their gain, right? They've deferred capital gains and they pay 0 in what we call boot. Boot is anything that's not like-kind real estate. Like-kind is anything that's real property held for investment. So land, right? Maybe where you're sitting in an office building or in your home, right? Hopefully not your car, because that does not count. But when we're looking at boot, that's actual receipt of funds. That could be cash, right? That could also be debt that isn't replaced. So what does that look like? Well, here's an example of the same sale. On your screen, you'll see that $900,000 sale, same mortgage loan payoff of $300K. Your commission's included with the buyer's agent in addition to title, escrow, transfer, right? Of that 60K, leaving that 540 with the qualified intermediary. You find them a property for 700 because they wanted something a little less to have some cash on hand. So they talk to their lender and they get creative. They say, Mr. Lender, I only want 260, knowing that $40,000 in mortgage is not replaced. Excuse me. So that 40K is not replaced because they had 300. That's what their loan payoff was. Number 1 and 2 indicate that the IRS has stated you have to acquire a property with the same or greater debt and use all the net equity for full tax deferral. This person said, well, I'm not going to replace that 40K. And you know what, Kayla, can you wire me directly 100 grand after I close on the replacement property after day 45? Absolutely. So now they're only using 440 net equity, that's the cash, and they have their loan of 260. This leaves them a combination of what we call boot, it's not real estate, right? Of 140K. Of that $140,000 boot, obviously 40 doesn't exist, it just wasn't replaced, but they still owe taxes on it. So we call that 40,000 in mortgage boot plus $100,000 in cash boot. They have a total taxable event occurring only applied to the 140K total boot in combination of the mortgage and the cash. So again, they're deciding to not replace certain monies from each scale, the loan side and the cash side. This gives them that total consequence of 140 applied to that. So that's so funny. One of my OCAR realtors is calling me right now. So do we have any questions on boot before I move on? So I bring this up because what if that person decides they do want to go down in value, right? And they're going to ask you, well, what am I going to owe? Well, you're only paying taxes on the amount of boot that isn't replaced, right? So you're going to have 140K boot on this. And what I did there is we reduced the cost of sale. So this, another misconception is, well, I sold for $1 million, I have to buy for $1 million. You sell for $1 million, let's not forget closing costs. That's not real estate value, that's an expense. If I sold for $1 million and closing costs are 50 grand on that property, probably 60 grand on that property, then your net number, if there's no debt, right, is going to be 940. My $1 million minus my 60K in closing costs. That leaves me $940,000 cash to do an exchange for full tax deferral. If I buy something less than the 940, I'm paying taxes on the difference. That's my taxable boot area. Pitfall number 3. Oh wait, pause, please. Christine had a question. So the tax on the 140K in boot would be based on the current capital gains tax rate. Is that 25%? Great question. I appreciate that more than you know. So capital gains taxation, there's 4 levels. We start with California. California state tax for capital gains is the highest in the country at 13.3% with an upward scale depending on millionaire tax. I like to go with 13.3 because that's what we know. The additional level, number 2, is going to be your federal tax rate, right? What's my capital gains tax rate? Not my income, my capital gains tax rate. For high earners, it's 20%. I think that's around 440, I'm gonna say 450. I'll have to get the numbers right, it changes annually. But as far as what we're looking for is 15% or 20% on the Fed. So let's say this person's a high earner. They have California at 13.3, they have the Fed at 20, right? So now they're already at 33.3% capital gains, but wait, there's 2 more levels. The next one is the net investment income tax, NIIT. That's 3.8%, that's healthcare tax. It was implemented in 2008. Okay, that's across the board. So now we're adding that in, right? So we're going up. And the last level is depreciation recapture tax at 25%. Now this is an outlier and I leave it to last because if that client has depreciated 100 grand of this asset, 25% of their depreciation is to be paid. So it's not added into the other percentages as a straight line calculation. It's only applied to the depreciation. So they would have paid 25% for depreciation, plus the other figures added, the net investment income tax at 3.8, the federal 15 or 20%, and the state tax capital gain at 13.3 for California. So on average, when someone tells me, hey, I have $1 million in gain on this property, should I sell it? What am I going to be paying capital gains taxes? Well, one, I can't give them specifics on what they'll be paying to the penny. I'm not their tax advisor. But if we look at those figures added together, it's really anywhere between, would you say 35 to 40, 42%. So we'll say it's 40% round number. 40% of the $1 million in gain, that's $400,000. So isn't it a win to do even a partial 1031 exchange, redeploy that investment, right? And some people, it just doesn't make sense for them. This doesn't apply, right? I think we have one more. I'm going to scroll down here. Oh, no, we're good. Okay, I hope that answered your question, Christine. It's a lot higher than we think, unfortunately. Okay, so this gets me to selling or exchanging into a property that is not held for investment, used in a trade or business, okay? Clients will ask me, well, I want to exchange and I want to move into it right away. Well, I don't sign their tax return, but I'm recommending to you as a qualified intermediary who's read this tax code through and through, they must wait 2 full calendar years before claiming it as a primary residence and moving into it, okay? You cannot exchange your primary residence into a primary residence. You cannot exchange, flip properties. I call them dealer properties, right? Stocks, bonds, notes, interest in a partnership or LLC. If I am a partner of an LLC with 5 partners and the LLC wants to do an exchange and I don't, I can't sell my shares to the other partners without creating a taxable event. There's tools in place for that we can discuss one-on-one if that ever comes up, but you cannot exchange your interest in the partnership, right? It's just real estate. REITs, real estate investment trusts, they're owned by a trust. The whole REIT can do an exchange, but you cannot exchange into or out of a REIT your shares again, right? We're not exchanging shares. We're exchanging real property. So what's qualifying then? Any relinquished property held for productive use in a trade, business, or for investment. Keep stressing on that one. What is the best way, Anna asked, what is the best way to find people that need investment properties? Right, so I would work with your title reps and discuss non-owner occupied properties, right? Start farming to those areas. There's a lot of investment club meetups where people just share so much knowledge. A lot of these people love to talk, so I love to listen when I'm at these, and I learn so much from them and partner with them. A lot of the time I recommend partnering with commercial brokers, believe it or not. A lot of people want to get out of commercial, and guess what? They still want to own investment property. They need to, this commercial broker needs to partner with what I call an exchange agent, someone who's very versed on 1031s, because commercial is bread and butter. Majority of commercial owners do a 1031 exchange. So when we look at non-owner occupied specifics, maybe that investor wants to go into rental properties. So now pitfall number 4. Oh, excuse me, let me dive in a little bit more of like here's my picture slide I wanted to show you, right? So here's an example. Maybe someone who owns what's called a DST or Delaware Statutory Trust. I'm sure we've heard this. They're everywhere right now. But when we look at DSTs, it's both a security and real estate. So this person maybe owns $2 million of this Amazon warehouse, and that DST sells what's called going full cycle. And the exchanger says, well, shoot, I only have 2 million. I don't want to buy maybe another single family, but could I be tenants in common with maybe my brother? And he'll bring his 2 million in and we buy a $4 million building. Absolutely. That's an effective exchange. Now, maybe this person wants to sell their tenancy in common, their 50% of real property ownership into land. Absolutely. Maybe their farmland has accrued a lot of interest and a developer wants to buy it. It has appreciation. It's an investment property. It's now exchanging into maybe a vacation rental up in Mammoth. Maybe they take that vacation rental and exchange it into oil rights, mineral rights, wind turbines. All of these have an APN, an assessor's parcel number. So we're getting real creative here. But you're asking, where do we find these investors? There's a lot of places to look. And last but not least, I love this one, is a duplex, triplex, fourplex. When we look at these properties, we have what's known as a split treatment. There's a lot of these in San Diego, near Pacific Beach, Crown Point, in addition to when we're going up in Laguna Beach, when we're going coastal, even further north, Huntington. So when we're looking at these properties of duplex, triplex, right, that we can represent as realtors, all the way up to fourplex, maybe the client lives in unit A and they're renting unit B. If they sell this as a whole, they can exchange 50% of it that appreciated. It's called split treatment. I get the primary residence advantages of living in unit A while simultaneously getting the benefit to exchange a portion of it into another investment. So same concept would apply for zoned R2, 3 properties with guest houses in the back, and then the owner lives in the primary residence in front, or flipped. Okay. So now pitfall number 4, using a person who is considered disqualified as an intermediary. Okay, this is a big one. Do I have to use a QI? Yes, you should use a QI. When we're looking at why QIs, why qualified intermediary? Well, I identified to my mom. I sent my ID form into my mom. Well, that's a fiduciary responsibility. That's a relationship to you over the last 2 years. Oh, well, I sent it to my attorney. Same concept. Oh, my realtor. Same concept, right? So when we're looking at the transfers and the binding contract in nature that we create, it is that assignment, and we work with the title companies in addition to our in-house attorney to prepare these, right? So we work on what's known as, we have our G6 regulations and restrictions that fall in line with 1031 breakdowns, that we make sure everything is falling in suit with 1031 tax code, okay? Of which that does have to do with identifying. Now, who's disqualified? I mentioned mom, right? Employee, attorney, accountant, realtor, of course, investment banker, broker, or relatives. So in addition to holding the identification, all of these things, what is my job, right? So I love teaching. This is one of my favorite parts about my job, is really educating you guys and being on your team as your partner. But we really create 1031 exchange agreements on every single exchange transaction. We have our own agreement. We have a notice of assignment or assignment of agreement, depending on which side we're going into, buy or sell. We have exchange account forms. We create segregated bank accounts for every single transactions that are completely secured by the FDIC. We can spread it as well. Detailed closing instructions, noting changes that need to be made on settlement statements. We have to be on that settlement statement. So instead of it saying John Smith as seller, it would say Leader 1031 as qualified intermediary on behalf of John Smith. That's that documentation that we need implemented, right? So we're educating, if an escrow officer isn't up to speed on this literature, how to implement that. So we are also a proud member of the FEA, Federation of Exchange Accommodators. They're the voice of the 1031 industry. I attend these conferences annually with my team. We're always sharp. Any new concepts that are coming up for disaster extensions, we're first frontline. And we are a member of the FDIC, backed by a bank. So whenever you're focusing on a qualified intermediary, make sure you ask the questions. Who are they? Who are they owned by? Where's my money going, right? It's good to know that for security of funds for you and your job as a realtor. Now, this is a big one. Pitfall number 5. Not consulting with a CPA or tax advisor before closing on the sale of a relinquished property. So as much as I'm pretty knowledgeable in this space and pretty dangerous when it comes to this topic, but when we're looking at maybe someone who went through a divorce, maybe someone that changed titles 6 times, and they took depreciation here or didn't there, you and I won't know any of this information, right? So it's always a win for the client to discuss with their CPA rather than consult with myself or you on these topics, right? We help them get the property sold, which is your job, and I help facilitate the exchange. I'm not telling them what their property tax implication will be in a new one. I'm not telling them what their capital gains will be on the sale, what depreciation they have. They should really, really focus on discussing with their CPA because every single property acquisition is different and every single taxpayer is different. Okay. It's good to evaluate the numbers, of course. So that's really the takeaway here. We're not going to give them that tax advice. I'm going to pause here 1 second. I think we're good on that for questions. I got one up here. Hi, James. Hope you're having a good morning. James asked, can you exchange in and out of DSTs? You sure can. They are highly illiquid, meaning you don't get control of when they sell. The owner who acquired that land and built, let's say, a multifamily apartment that they're now calling a Delaware statutory trust or security and real estate can offer pieces or beneficial interest to investors. They are in control when they want to sell that property. Sometimes it's 5 years, sometimes it's 3, sometimes it's 7, but the max hold is 10. So you could be tied up in that investment for 10 years. But when they're ready to sell, you can exchange out with your gain, right? Into, let's say, a single family residence held for investment, maybe that vacation rental. So it is still classified as like kind. Okay, here. Pitfall number 6, not handling partnership LLC issues properly. So this came up, right? Exchanging and ownership, and we talked about joint tenancy. I think Tony mentioned that joint tenants, will that work? So the entity that sells must be the entity that acquires. So Kayla Franklin's my maiden name. If I sold my property, my condo, which I did in Oceanside years ago, right before I got married, and I exchanged it into land in Texas. When I did that transaction, I was on title, even though my husband and I got married in between that, and I'm now FERCing, right? I had to wait 1 year and a day because that was my own individual sole and separate property. After 2 years of owning it, I added Trevor, my husband, to title. Okay, so the entity, Kayla's Social Security, Kayla Franklin was that tax paying, even though my name changed, my tax paying entity of my Social Security is the same. All right. When I added him on title, we're married filing joint, it turned into his social, right? So same concept. If husband and wife sell, husband and wife acquire. Now, if it's an individual that sells and they want to buy in a living trust, they can. It's the same taxpayer. Okay, if a sole member LLC sells, they can buy in their individual name. Why? Because a sole member LLC is disregarded, right? Meaning it's disregarded in nature to hold its own taxpayer ID. If a regarded LLC, which one stands alone, has its own bank account, taxpayer ID, if a regarded LLC exchanges and sells, the regarded LLC has to purchase. I cannot change that taxpaying entity of my LLC that's regarded midstream. Why? That's property tax basis shifting. I'm now giving that new LLC ownership rights of that gain that's now wiped away. That will raise a huge red flag with the IRS. Okay. A lot of the time we have terms that are called that coincide with this third bullet point that are swap and drop and swap, right? So I talked to a lady this morning. She's going through a divorce. She's deciding if she should drop and then swap. Drop meaning change title or drop the current entity ownership title and then do an exchange. So her and her ex-husband will be 50-50 and they can go their own individual routes. Possibility, depending on how long she holds, right? Intent to hold for investment. The other option is maybe do like out of this LLC, there's 5 partners. We drop into tenants in common, hold that property for 2 years, then do a 1031 exchange into 5 different directions because there's now 5 taxpaying entities that we're all partners under one partnership, but we changed title. So now we can go freely, right? It's good to really examine that title and ask those questions. Well, who's the actual owner here, right? Who's going to be signing the contracts, especially? That's why I mentioned to Tony early on, and everyone listening, tenants in common. If you are doing an exchange and you're working on investment property, typically the best possible ownership strategy is tenancy in common. Again, if Tony and I are tenants in common on title to an investment property and I own my own LLC, he owns his own, it's two LLCs, tenants in common with each other, but now we're secure with our own LLCs as our umbrella, right? Just in case, if you will. So we can exchange our own ways, or Tony and I say, hey, it's been a great partnership on owning this investment property. Should we buy something else together? Sure, we can, as tenants in common. We're separate taxpayers though. Just another question. Are C Corps, S Corps excluded? No, so the C Corp would do the exchange. S Corp would do the exchange. That is a regarded entity. I love that, Anna. So yes, they're doing the C Corp is doing the entire exchange. Just because there's the managing member or there's the president of the corp, they're signing, but the corporation is that tax-paying ID that's doing the transaction. And then the second tier here is from personal to those that, oh no. So you cannot go from a C Corp into your individual name. It needs to be the C Corp to the C Corp. The entity that sells acquires. The only time we see changes of the name on title is going to be Kayla Firking and the Firking Family Trust, right? Living trust or living revocable trust. That means that I'm the trustee of that trust. It's still my social security number, right? I'm putting an umbrella for security purposes for beneficiaries and ownership and my trust, but I'm still the taxpayer doing the exchange. Other than that, C Corps, S Corps, regarded LLCs will all remain the same doing the exchange. All right, so diving a little deeper, we can read that title on the relinquished property, Kayla Franklin, but maybe she's buying in her trust. I ask those questions. Is that an irrevocable trust or a revocable trust? Oh, well, Kayla, it's revocable. Oh, perfect. We want to buy in our individual names now. Okay, that's fine. Right? They're not creating a tax consequence and shifting anything. Let's see here. Make sure I don't miss anything. Okay. Financing issues, husband and wife. I think I covered that. So moving on to pitfall 7. Not evaluating the entire exchange transaction on both sides. Okay, so if your job is to represent this exchanger, your seller, who will then become a buyer, and they're asking you these tough questions, well, what am I exchanging? It's good to know and avoid these deer in the headlights responses of, I don't know what you're exchanging. Back to square one, right? We're looking at replacing the value of real estate, the net equity and the debt. My little jingle, net plus debt. Right? Combination of those two for full tax deferral in the purchase. All right. Timing. This is a big one. All is dandy. We set up the exchange. Now they've closed escrow and it's day 0 today. Tomorrow's day 1. And they look at you. Well, what's next? Oh, well, we have 45 calendar days, a month and a half to find new property. What? It's good to educate your client ahead of time. Hey, we're going to have to find something and put it in writing and identify it to our qualified intermediary by the 45th day at midnight. Okay, so let's start hunting now that we're in escrow on the relinquished property. Secure both, right? Know what's to come. Educate what's ahead of time, because a lot of times people can't find replacement property in the day 45 window if they weren't educated on this timeline. So 1031 exchange investors in this last bullet point, they need to adapt to the changes of the current market conditions, right? This is a big one for where we are. Inventory can be low. What do I do? These secure safety nets, if you can't find them replacement property, there's a couple options, right? One, they don't ID and the cash goes back to them on day 46. We call that a blown exchange. They attempted to do it, couldn't find something, the money goes back. People elect to do that. Obviously they don't want to pay taxes. So option 2 is maybe find a backup property, something like a Delaware statutory trust that they can put their money into for 3-5 years that has a good return. Another option would be buying something that's not the most desirable, but own that property for a year and a day to 2 years, exchange again, right? So those are your options. Really 3 categories there is an alternative investment DST, loan exchange, or a backup plan that's not the most desirable property. But again, you can exchange down the line. So closing costs, and when we're understanding the replacement, this kind of coincides with that equation pitfall of understanding what we're exchanging to valuation, being ahead of it. All of these are exchange expenses, which are closing costs, right? So these are deducted from that sales price. They are not required to be replaced in a 1031 exchange. Broker's commissions, exchange fees, transfer fees, escrow fees, recording fees, title insurance fees for the owner's policy, title insurance, attorney or escrow fees incurred in connection with the sale or purchase of the property. All of these reduce that sales price, right? But they do not need to be replaced in the new property. It cut down that sales price for what the net will be plus the debt to the exchanger taxpayer. Let me get up here. I'm losing my cursor. Here we go. Okay, Q&A is here. Okay, hi Debbie. Debbie has a question here. Can you sell a property and build an ADU on your personal residence? You cannot exchange into property you've already owned. So if you're buying from yourself a portion of the land, that's a no. If you did buy a property, let's say you own a primary residence, you can build an ADU and then utilize that split treatment, right? So when it's time to sell, it's an investment property. Now a portion of that ADU, whatever the square footage value per dollar is, you're exchanging that amount when you sell it, but you cannot exchange into something new that you already own, new in the exchange, but not new for ownership, according to you and your taxpayer on your primary residence. Tristan, hi Tristan. What if the 45 days is up and no ID property? Okay, so if we don't have an identified property, the cash we're holding is wired back to the exchanger, taxpayer now, on day 46, and they're facing a taxable event. Okay, so we want to avoid that at all costs if we can. Find them some good backup properties. So again, no ID, day 46, the money's wired back to them directly. Okay, checking this other spot for questions. All right, we got closing costs. And we already discussed this, but here's the visual. I know someone asked for capital gains taxation, Christine. Depreciation recapture, net investment income tax. So created in 2008, effective 2013, there you go. Low to high earning threshold, 15 to 20%. Applicable state tax, we talked about California being the highest, 13.3%. I use this as a scale, not all states. Some states have 0 capital gains taxes, we know, right? Your Tennessees, your Nevadas, your Texas, right? So when we're looking at this in Florida, so when we look at Mass, that's on average about 5%. We're so much higher, right? So this is an incentive when you're looking for your sales pitch. Hey, do you want to pay 13.3% capital gains taxes on your investment property, or we can exchange it and you can keep rolling it for your lifespan, get a higher return on the new rental, leverage it by 2. There's so many spinoffs to this, right? In a sales pitch. So that is a huge figure for Cali. We have to remember that 13.3, highest in the country. Wow, wow, right? I do have another question up here, it looks like. Tristan, oh, thank you. You're very welcome. And Christine, if I have a primary residence that I convert to a rental and later exchange, am I still able to deduct my upgrade expenses to reduce the capital gains taxes? Am I still able to deduct my upgrade expenses? So if you're doing an exchange, you're doing an exchange. You're not getting money back. And I think that's a common misconception as well, right? Well, I improved this property. I put 100 grand into it. I want the 100 grand out, and then I'm going to do an exchange on the rest. You're going to pay taxes, or you're going to pay taxes on your boot of 100 grand. Okay, so any which way, if you do a 1031, it's either all or nothing, or the partial exchange where you're paying a portion on boot. I hope that answered. So if you're putting money into it, yeah, you're welcome. Yes, good. Okay, I did my job. All right, let's move on to our last pitfall here. Oh, actually, second to last. Pitfall number 8. What are we avoiding next? This is a big one, especially in SoCal. We have generational wealth, we have generational real estate, right? So engaging in related party transactions. Oh, well, I'm representing a father who's selling to his daughter. So I actually had this personally happen, a condo I lived in Oceanside, while commuting between Orange County and San Diego, perfect spot. My dad owned it. And I moved in there, gosh, I was 23, 24. And I lived there for about 3 or 4 years, starting my real estate career. And I wanted to buy it from him. I saved up enough money and I said, Dad, I want to buy your property. Okay, but there's related party issues. Well, what does that mean? Well, you can't buy it from me unless I exchange out, Kayla. So my dad had to do a 1031 exchange out of his investment property where I was a renter. After I bought from him, he couldn't touch any money. He had to exchange into something else himself. So related party transactions mean 50% related, at least, right? And no one is ending up with money. Okay, well, I'm buying my dad's primary residence in a 1031 exchange, but it's his primary. That's a no-go. That will not work. I mean, you can try it, but you're going to get audited. It's the IRS, right? So what I'm doing there is taking my tax-deferred money from one investment, buying my father's primary residence. He's getting a tax exemption on a primary residence exclusion under Internal Revenue Code 121, which we commonly know as 250K exemption on single filers of gain on your primary, right? Or 500K for married filers on your primary. So now he's using my tax deferred proceeds, sheltering it on his sale. And what's going to stop dear old dad from handing me some cash? That's inheritance annually, tax-free. That's the reason why. So be very, very cautious that nobody ends up with money. When someone says they have a strategy, oh, I'm just going to sell it to my brother. Oh, I'm going to sell it to mom, right? No one ends up with money. Okay, here we go. More questions. Michelle, hi. So glad that I attended. You're a Firking? Wait, what? Such an awesome family. Oh, Michelle. So hopefully you know my my family, my husband, maybe my dad. I think you may know my father-in-law. We'll see. Anyway, so sweet, so sweet. So takeaway for that, we got on the related party and going into the final pitfall. Bum bum bum. Not understanding reverse exchanges. This one came up early on, right? Can we do a reverse exchange? What is a reverse exchange? It's an acquisition of an investment property prior to selling and in another investment property. We'll define the terms: a replacement and a relinquished. The one I'm selling, I'm relinquishing. The one I'm selling, the relinquished property, has cash on it, right? My net equity. Well, I want to use it to buy over here. That's what we've been talking about the whole time. I'm deferring my gain and moving money from one sale into the other. Okay, but if I'm doing a reverse exchange, I'm acquiring this one first. I don't have any money from the sale. So the tricky part, pros and cons, well, this one's available now and I want it now, but I haven't listed that one. How do I do that? Well, you have to come up with enough cash or cash and debt combination, right, to acquire that replacement property first. And in order to do that, we have what's called as an exchange accommodation title holder, an EAT, E-A-T, another acronym. Okay, so when we're looking at an EAT, it creates a brand new LLC. So there's this new entity created, right? So this is that entity to entity. We're in a way duping the system of saying, hey, this LLC is buying the replacement property with cash. That let's say this exchanger taxpayer has $1 million to buy this new property in cash. They buy it, the LLC goes on title. At close of escrow, they have 180 days, of course, excuse me, in their exchange period to sell their relinquished property. Once they sell the relinquished property, the sale proceeds from that transaction are wired into that segregated account we've prepared and then immediately dispersed to the exchanger taxpayer. So it fills back up their savings account, maybe replenishes a 401k, pays off a loan, what have you. So this is a way to put the cart before the horse. Now, I mentioned they are more expensive. They are. We work with attorneys, and if you need fee pricing and all that, we'll do that off. This is educational purposes only. So there is an improvement exchange as well, making improvements to an existing replacement property. What that means, right? Let's say I sell my $1 million relinquished property and I buy something for 800. There's 200 left, but that property needs a new roof. That property needs, I don't know, maybe new foundation in the back, or it needs new electrical. If that's the case, right, then they can draw on those sale proceeds held in that exchange account and improve the property so long as it's identified, right? So let's say I'm buying a 3-2 single family that's 2,100 square feet and 50 grand improvements for new roof, plus 100 grand improvements for all new plumbing. Now I'm at 150 in, right? So now my identified ID form is identifying or unambiguously describe what the value of my real estate is, so they can draw on those funds to improve the investment property rather than paying taxes on it, right? Built to suit exchanges, these aren't really done in our state. It would be exchanging, buying an investment property that's land and building it from the ground up. Completion, of course, has to be done in 180 days. We don't really have the luxury of doing something in 6 months. You can exchange into a new build property. I know that my parents did one, gosh, 2 decades ago, I want to say, that the home was half complete and it was still ready. You know, it was listed. They needed an offer deposit from a builder in San Marcos. They went out, put a deposit in, and their timeline was still that 180 days, but they closed escrow on that property on day 142. And I remember that because it's when I started learning about exchanges. So it was still being complete. They identified what was to be produced, right? 4, 3.5, 3,200 square feet, San Marcos, 92069, know the property. So that one was okay because they ID'd it perfectly. Built to suits, you talk about coastal commission, you talk about getting anything for approvals for permits, that takes time, right? So once we've done an exchange and we want to ID, we might be behind the curve there. So before I get into highlights, I'm going to answer these 3 questions. 2, sorry, Rosalina, can you exchange on a lesser property then add your related family member into the deed? How does that affect anything? Pros and cons, please. So if we exchanged into a lesser property, so I sold for $1 million, and I hope I'm tracking, tell me if I'm not, but if I sold for $1 million and I bought for, let's say, 800, that's my property I exchanged into. I'm the taxpaying entity. I can always add someone on title, but remember, if I sell, the whole thing is going to be taxable to me depending on how long the ownership has been in place, right? So here's another personal example I like to use, things we can relate to. My father did a 1031 exchange on an investment property, and he went in with my brother and sister-in-law. So they did an exchange of into a $1 million home. They put 800 grand into that property. So they're 80% tenants in common. My brother and sister-in-law brought in 200 grand of their own cash, right? Now they own that property together. So you can add someone to the title, but as tenants in common to purchase more, it split the ownership of the valuation of what each investor put in. So you can do it either way, but anytime there's a liquid event, they cash out, taxable event, right? And then Anne asked, can the reverse exchange period be longer than 180 days? It cannot. The only time that we have extensions in IRC section 1031 fall underneath our disaster extensions, right? We had what we just saw for all the hurricanes that have occurred this year, a lot in Florida, in Georgia, in the Carolinas. We had a ton of extensions that pushed timelines out. Now, oh, it's a win. Is it though? Is the property still intact? So people want these extensions, but under what cause, right? 2 years ago, we had an extension in California, actually trickling into last year too, that were for flooding. So where that extended the exchange timeline and identification period simultaneously, but we very rarely see that. And again, I don't know if it's a win in the flooding situation. Do we want a property to be damaged? And sometimes it applies to the owner in the specific area. So let's say for this regulation of the disaster, I was living in San Diego and I had a property in Napa that I wanted to exchange, but Napa was fine and there was flooding in my area. I still got an extension because I may have gone hardship, right, with my own primary residence where I couldn't execute the timeline. So whenever these come up, we always have a LinkedIn post that we send out. I want to start putting them in blasts and newsletters as well, just in case. But typically they're along the Southern Belt or, more hurricane prone states is where we see those disaster extensions. So thank you for the questions. And then the highlight of the exchange, right? When we look at the delayed exchange, that's what we covered today. Moving the sale proceeds from the relinquished property to acquire a replacement property. We very lightly touched on reverses, right? But the take home is moving that capital from one to another. That's the delayed exchange or tax deferred exchange because we're deferring the taxes. Always, always consult with me, qualified intermediary. See if it makes sense. There are no stupid questions. Again, if you call me and it's a 30-second call, fine. If we got you to a solution and you're moving on to get a deal, that's a win for both of us, right? Ensure that the sale contract is assignable and that the buyer is made aware of such assignment. That assignment is indicating part of that cooperation clause, right? The seller's doing a 1031 exchange. We're assigned into that settlement statement before closing, right? Before close of escrow. We have to do that intent to perform the 1031, release the buyer from the liabilities and notify the buyer in writing of the assignment to the QI, which is what we do, right? So we have to prepare this. For full tax deferral, reinvest net exchange proceeds in addition to acquire a property with the same or greater debt. That's your value, right? You wipe away the expenses and the closing costs, you're left with those two items. Number 5, the taxpayer must identify the replacement property to be acquired in accordance with the rules of identification within 45 calendar days. I have a gal, she sold a Huntington Beach property with one of my Rockstar Women's Council of Realtors out in Orange County, who I just missed her call, but we just went through this exchange and believe it or not, her identification period is tomorrow at midnight, 1031. I don't know, I think it's hilarious. So I'm like, wow, what are the odds that you got that? So she still hasn't sent me her ID form, okay? She said she's going to send it tomorrow morning, which is fine. As long as I receive it by midnight on the 45th day, that final day, our clients can revoke, revise, do anything they need to that identification form. The taxpayer must close on that replacement property, the ID, by the 180th calendar day, or their next filing date, excuse me, whichever is earlier from the close of the relinquished property sale. All right. So I know someone asked for contact. Here's my cell phone number on the screen, my email that you can reach me at. I am local, so time zones are not an issue. I do travel a lot. I'm very versed on different states. So if there's a question that comes up where, hey, my client's exchanging into this state, what happens if they sell the property in 20 years, right? Call me, we'll chat about it. Let's see, Anna, can you put your email address in the chat for us? Yes, there you go. I appreciate that, Anna. I hope we get to work together. And then Anna, I've heard you can provide up to 3 properties that you're considered. Is that true? Yes, so in the identification rules, right? There's a multitude of identification rules. The most commonly used one is the 3 property rule. That means the client can identify up to 3 replacement properties, regardless of their fair market value. Okay, so they sell for $1 million, maybe property 1 is 1.2, property 2 is 2 million, and property 3 is 2 million, right? When added together, those are 5 million and change, 5.2, I think is what I said, total. but there are 3 properties that I could potentially want to go into. That's an effective strategy for the 3 property rule use. However, what I hit home early on is if I did ID those 3, I fall out of property 1. Now my backup is property 2. I do an inspection and I hate it. I fall out of that property. Now property 3 is already in contract with a buyer and I'm on day 50. The IRS forces qualified intermediaries' hands to hold the sale proceeds until day 181. Okay. So just because it went into contract or you didn't like the property because the inspection went awry, right? In that situation, you still are not in use. You can't use your funds until day 181. So it depends. Some people prefer that because they're waiting for the next tax filing year, right? Another couple other rules apply to investors that want to diversify beyond 3. We can talk about that one-on-one. The takeaway for today for the pitfalls, right? I really hope you understood the highlights and also the 3 property rule, right? That's the most commonly used one for residential. And I have one more question, it looks like. Thank you, Anne. David, will we all have access to this recording? Yes, I believe so. Elsie, I think she said there will be some edits and then yes. Please, unless I said something wrong, who knows, don't record it. Rosalina, please confirm day 1 of 45 starting from close of escrow, including recording title. If I record today, it's day 0. Tomorrow's day 1. Right? So I closed escrow today. We recorded today, probably at 4 p.m., right? It's day 0. Tomorrow is day 1, right? So I recorded, closed. Tomorrow, starting my exchange timeline, the next calendar day at day 1, right? I hope that answered your question. And typically, I want to make a note here. We don't really receive funds. If it's a Friday and there's a recording, we won't receive funds until that following Monday, usually, especially in afternoon closing, right? So if you need cash for an earnest money deposit on a replacement, we won't be holding it until we effectively have the cash to wire it back out. Now, the client can use their own personal cash as a placeholder for an earnest money deposit, okay? So if you're trying to secure both at the same time, they use their own cash as an earnest money deposit and receive it almost as like a rebate, but it's a placeholder. Here's 10K now. When I do the exchange, it's going to offset that 10K with my sale proceeds. My 10K comes back to me tax-free. So that's a good tool or trick of the trade, if you will. Christopher, if the seller is in California, can the replacement property be in any state? How about US territory? It can be in any state. Remember, this is a federal tax code created in 1921. So all 50 states, and yes, you can go in US territories as well. I had a gal this last year do US Virgin Islands. So that was a fun one. I learned a lot on transactions and contracts there. Brooke, hi. Brooke is asking, can exchange funds being held be used to pay for insulin section and appraisal fees? No, it cannot. Right? So we talked about the expenses there. You can't pay for inspections, right? Because what's going to stop you from going into contract as an offer? That's your inspection you pay out of pocket. It's not an actual exchange expense. Brooke also said, oh no, this is it. Can exchange funds being held be used to pay for inspection and appraisal fees? Oh, I got you edited. Yep. No, unfortunately, no. Okay, let me go down here over to the chat. I'm going back and forth, multitasking. Thank you for your patience. Thank you, Terry. Appreciate it. Okay. And Seema. Okay. That about wraps it up for me, unless anyone has any final questions. I really, really appreciate everyone attending again. Thank you for your time and investment in yourselves. Hit the ground running. Let's go get some deals. It's the end of the year. Let's finish strong. Anything you need, you have my cell phone now. So you can absolutely call, text 760-622-7716 or my email, Kayla.Frerking, FRERKING @leader1031. All right, I hope you all have a wonderful 1031 day. We'll see you soon.